California, the land of endless sunshine and seemingly endless appreciation for home values. But what if I told you that the golden era is finally over? For a solid decade, the Golden State defied gravity, with prices soaring 300% to 400% in major metros since the 70s, far outpacing the rest of the nation. But 2026 is shaping up to be the year of reckoning. The cocktail of persistently high interest rates, mass corporate layoffs, crippling property insurance costs, and the largest outmigration trend in state history is finally cracking the foundation. Forget the statewide forecast predicting a mild rebound of 3.6%. We're not talking about California as a whole. We're diving into the 10 hyperlocal markets where the crash won't be a correction. It will be a bloodbath for overpriced homeowners. If you own property, are thinking of buying, or just want to understand the economics of a housing disaster, you need to watch every minute of this video. Get ready. This is where the California housing dream goes to die. Before we name the cities, let's understand the why. A crash is not a correction. A correction is a 5 to 10% dip. A crash is driven by fundamental economic pain. The first crisis point is the unaffordability tipping point. The median California home price is projected to cross $900,000 in 2026, yet the state's affordability index is barely scraping 18%. That means only 18% of households can afford the median-priced home. When over 80% of the population is locked out, you have no local buyer pool left. This is a demand crisis. The second is the mortgage rate hangover. The vast majority of homeowners are locked into sub-4% mortgages. The few new buyers who enter the market are paying 6% to 7.0% plus. This has functionally reduced buying power by 30 to 40% overnight, collapsing the number of potential bidders and eliminating the bidding wars that sustain the market. Finally, we have the inventory avalanche. Reports show active listings statewide are up over 16% year over year. In high-risk, inland cities like Riverside, Stockton, and Bakersfield, inventory has reportedly doubled. The longer a home sits, the more desperate the seller becomes. That desperation leads to price cuts, which create a downward spiral of declining comps. The cities we're about to name are where these three pressures, non-existent demand, crushed affordability, and soaring inventory, are most acutely felt. Starting the countdown at number 10, we have Oakland in the East Bay. The core risk here is tech flight and commuter fallout. With a median price around $1.2 million, inventory is up 25% year over year in the East Bay. Our projection suggests a drop of 10 to 14%. Next, at number 9, Santa Cruz. This is a case of hyper-expensive coastal luxury. It has some of the highest price-to-income ratios in the nation, and the remote work exodus hurts. We project a drop of 12 to 16%. Moving inland to number 8, Stockton in the Central Valley, where the risk is foreclosure risk and overspeculation. It relies heavily on Bay Area commuters, and mortgage delinquency rates are rising faster here than on the coast. Expect a 14 to 18% decline. Number 7 is Fresno. This is where the affordability ceiling hit hard. The median value is over $400,000, but wages are low. Home price appreciation was unsustainable, rising over 50% during the boom, leading to a projected 15 to 19% drop. At number 6, Riverside in the Inland Empire, we see an inventory explosion and builder glut. There is a high volume of new construction hitting the market simultaneously with rate stress. The crash could be between 16 and 20% here. Breaking into the top half, number 5 is Los Angeles, specifically certain suburbs. Here we see the luxury bubble pop. Areas like Malibu and Beverly Hills are seeing sales volumes plunge more than 40%. Buyers for multi-million-dollar homes disappear in a recession, potentially dropping prices by 18 to 22%. Number 4 is San Diego, particularly inland and northern areas, vulnerable due to military and tech layoff sensitivity. Inland suburbs were the biggest gainers, making them the most vulnerable. Our projection is a 19 to 23% decline. Number 3 is Bakersfield, which faces oil and agriculture volatility. Its economy is vulnerable to commodity price swings combined with an inventory spike. Days on market is soaring, suggesting a crash of 20 to 25%. Now for the top 2. Number 2 is San Jose and Silicon Valley, driven by the mega layoff factor. This is historically one of the most overvalued cities. A single massive tech downturn can trigger a spiral, especially since the luxury condo market is frozen. My experience tells me that once tech confidence breaks, the high-end and highly leveraged market is where the true dominoes fall. We predict a drop of 22 to 28%. And the city most vulnerable to the 2026 crash is number 1, Sacramento in the metro area. The key risk is commuter exodus and public sector risk. Sacramento gained the most from the Bay Area flight, leading to massive overvaluation without the job base to fully support it. It shows the highest correlation with Bay Area distress. Our projection is the highest, 25 to 30% decline or more. So what does this all mean for you? If you are a current homeowner in one of these 10 markets, this is a time to deleverage and prepare for negative equity. But if you are a buyer or an investor, this is the moment you have been waiting for. A 20 to 30% price drop in Sacramento or San Jose translates to hundreds of thousands of dollars in savings. The crash creates opportunity for those with dry powder. The data point is that the National Association of Realtors predicts mortgage rates will ease towards 6% in 2026. Lower rates combined with crashing prices is the perfect storm for an investor. Do not wait for the mainstream media to admit the crash is real. By then, the best opportunities will be gone. Like this video, subscribe for more real data, and let me know in the comments which of these 10 cities surprised you the most.